So welcome to Jumbo IS and welcome to our lecture series called Prelims Powerplay. In this lecture series, we cover the entire year's current affairs. Important current affairs, important from the perspective of your prelims examination this year. The thing is that we have divided all these important current affairs into subjects, and we will cover each and every subject one by one so that it becomes easier for you to revise all the current affairs from the past 1 year. Now, don't think of it as just a current affairs lecture series, because you see, current affairs are also related to static portion of your preparation, right? 50% of the MCQs asked in your prelims examination would be directly or indirectly related to current affairs. Therefore, you cannot ignore current affairs at all. And the best way to cover 1 year's current affairs is by dividing them into subjects and then covering them. So through this lecture series, we will cover all these current affairs, all these important topics, subject-wise. Now, if you have been following our lecture series for quite some time now, you know this that we have started with the subject of economics in this Prelims Powerplay series, and we are going to continue with that. But don't worry, other subjects are also going to come. Don't worry, we will cover all the current affairs before your prelims examination. Okay? Then let's just start with the lecture because time is of the essence. It is very important. Prelims is round the corner. Not much time is left. Therefore, we will straight away dive into the lecture. So without further ado, let's start the lecture. Alright? So yes, in the previous lecture, we had started with fiscal policy. Right? And within this topic of fiscal policy, we covered these topics. Okay? So within the topic of fiscal policy, we had to cover these 6 topics. Of these 6 topics, we have covered top 3. We have covered quality of government expenditure. We have covered a second topic, which was very fascinating. Are Indians overtaxed? Then we covered sovereign gold bond scheme and why did the government decide to discontinue with this scheme. Today, we are going to start with these 3 topics. Okay. Number 1 among them would be windfall gain tax on oil production. Number 2 would be loan from National Savings Fund. What is National Savings Fund? Small Savings Fund. And number 3, indexation in calculating LTCG tax. LTCG stands for long-term capital gain tax. So these are the 3 topics that we are going to cover today. So without further delay, without further ado, let's start discussing them one by one, starting with, well, windfall gain tax on oil production. Okay, now to understand what this topic is all about, you need to understand the term windfall gain, because only after understanding the term windfall gain, you'll be able to understand windfall gain tax and how is it related to oil production. Okay, so first of all, first things first, let's try to understand the term windfall gain. Well, the definition goes that windfall gain is sudden, unexpected, substantial gain in profits. So whenever there is sudden, unprecedented, okay, not unprecedented, but sudden, substantial gain, unexpected, substantial gain in profits due to some external circumstances, due to some fortunate event, unplanned, sudden gain in profits occur, that is known as windfall gain. And if government decides to tax that extra, sudden, substantial gain in your profits, that would be known as windfall gain tax. So windfall gain tax is a tax that the government levies on sudden substantial gain in profits. Simple. Now, how is it related to oil production? The thing is that 3 years back, well, there was this mega event called Russia-Ukraine war, right? Now, because of Russia-Ukraine war, well, oil markets, well, they came down. What do I mean by that? Russia is a substantial producer of crude oil, and because it was involved in a warlike situation, there were supply cuts as far as crude oil is concerned. So global supply of crude oil went down because of the war. Okay. Now, when global supply of crude oil declines, demand is still here, but supply falls drastically. Because of that, prices skyrocket. You all know this by now, right? That whenever demand outstrips supply, prices rise. So when demand is more than supply, prices rise. So because of Russia-Ukraine war, the supply of crude oil globally well, it dropped significantly. And because of that, there was substantial increase in prices. Substantial increase in prices. And I'm talking about international crude oil prices. Now, the thing is that basically India imports 70% of its crude oil requirements. Okay. So 70% of our crude oil demand is met through imports, but 30% is produced domestically, right? 30% is produced domestically. Now, these domestic producers of crude oil saw an opportunity because international prices were rising, they were skyrocketing. They thought, our Indian oil producers thought, that let's sell this oil in the international market because we will gain out of it. Prices have risen to a substantial level. Okay, so it's better for us. We will earn more profit if we will sell this oil that we have produced in India in the international market, right? But the problem is, if all domestic oil producers do that, they export all the oil produced in India out of India. So there will be less amount of crude oil available for India in the Indian market. So the supply of crude oil in the Indian market would drop further. So within Indian market, demand is still high. Supply of crude oil has dropped further because our domestic oil producers have decided to sell it abroad, right? So there will be substantial inflation of crude oil in India domestically, right? That was the situation because domestic crude oil producers saw an opportunity to earn a lot of money. And this was windfall gain for them because internationally, because of the Russia-Ukraine war, well, prices skyrocketed and they were able to sell it abroad and they were earning a lot of money. That is known as windfall gain for these domestic oil producers. Okay, this is known as windfall gain. Now, the problem with this windfall gain is it was a very nice thing for all these domestic oil producers, but it was bad for India in general. Why? Well, if all these exporters decide to sell this oil abroad, there will be little left in India. So there would be supply shortages of crude oil in India. Now, how would those supply shortages be met? Well, India will have to import further. But already international prices are high, right? Already international prices are high. So our import bill will rise. So therefore, we have to solve for this problem. Government of India thought we have to solve for this problem. So Government of India came out with an idea, very simple idea. That idea was that all these domestic oil producers who are earning supernormal profits, let's tax their supernormal profits. All these domestic oil producers who are selling abroad, okay, and earning supernormal windfall profits, let's tax those extra profits, okay? Because if Government of India taxes these extra profits, well, these people, these exporters would have to sell their oil at a even higher price abroad, higher than all the other competitors that they have. So they won't be able to export that much because Government of India is taxing exports. So exporters won't be able to export that much. It would be burdensome for them. So they would be forced to sell in India. And when they'll be forced to sell in India, what will happen? India will have no shortages and India will be saved. All right. Now, this was windfall gain tax applied on domestic oil production of crude oil. Okay. And it was applied like 30 to 33 months ago, 3 years ago, basically. Right. But recently, Government of India decided to scrap that, to finish that. Okay. Why did the government decide to do so? Well, let's look into that topic. Okay. But the major point, I hope I have been able to explain it to you. Okay. The main point. Okay. All right. So, windfall gain tax. Like I said, windfall gain means that when you have supernormal profits. Okay. And these supernormal profits are, well, taxed by government. Clear? Now, government introduced this tax on domestic oil producers. So what was the situation 3 years back? Tax was applied on domestic producers of crude oil and export, mind you, export of diesel, petrol, and aviation turbine fuel. Basically, aviation turbine fuel is fuel that is used in airplanes. Okay. The levy applied in the form of cesses. So these taxes on supernormal profit were applied on the in the form of cess. Okay. There's a cess, we'll talk about it. The purpose, like I've mentioned before, is very simple. Domestic supply of fuel had to be ensured so that more and more exporters do not export it abroad. You had to tax them so that they are discouraged from exporting and they are forced to sell in India. So supply of oil in India remains, well, adequate, and that would not fuel inflation. Inflation would be under control. All right. Plus, if some exporters are still wanting to export, if some exporters still export, then this tax would generate extra revenue for the government. So the purpose was twofold: revenue generation and domestic supply of fuel. Clear? Now the thing is, why was this removed recently? The thing is that after the initial hiccup of Russia-Ukraine war, international oil market stabilized. Russia started producing crude oil again and started supplying it to the international market. So the supply of crude oil came back. Prices came down. And the international market of crude oil, which was facing supply shortages, well, it did not face any supply shortages anymore. Prices stabilized. Now that the prices were stable, there were no windfall gains to these exporters. So government was not able to earn anything because government was actually taxing these supernormal profits. But supernormal profits reduced. So now what will government tax? Right? And plus, in India, there was no shortage of domestic or there was no shortage of crude oil in India. Clear? So the supply of crude oil in India was stable. The prices in the international market were stable. So these oil producers were not earning supernormal profits. So there was no objective. This windfall gain tax was added for a particular objective, right? That objective was solved because the international market stabilized. So the government decided to remove it completely. Okay. Now, one more thing from this topic. Okay. About this thing called cess. So basically, what is a cess? Cess is a tax on tax. And why did government apply this windfall gain tax in the form of cess? Okay, first of all, cess is tax on tax. So for example, there is GST. Okay, let's suppose GST is 18% on something. So on that 18%, government has applied, let's suppose, 10% cess. Swachh Bharat cess. Okay, so cess is tax applied on tax. So already these domestic oil producers were taxed. You applied an additional tax on their tax. That was the cess. So these windfall gains taxes were applied in the form of cess. Just remember that. Now, why did the government choose to basically apply these taxes in the form of cess? There is a very simple reason behind it. Look, the thing is that, well, all the taxes earned by central government, all the taxes that are earned by central government, well, central government collects those taxes and then central government has to share some of these collections with the state governments. And this sharing is as per the decision of Finance Commission. So Finance Commission says that you have to share 42%, 43% of your central fund of all taxes, central divisible pool with states. Okay. The only caveat is that cesses collected by the central government are not to be shared. Government will not share cesses. They will share all the other form of taxes or money accruing from all the other form of taxes. But cesses will solely go to the central government. They won't share a penny with state government. So actually, these taxes were applied in the form of cesses so that central government could earn money and they won't have to share it with the states. Okay, this exclusively went to central government. Clear? That's why it was applied in the form of a cess. All right, simple. Okay, now let's move on to second. and that is, well, loan from National Savings Fund. Now, first of all, what was in the news that we have kept this thing in today's lecture? Loan from National Small Savings Fund. First of all, you need to know what a National Small Savings Fund is, right? So you see, government has many small saving schemes. So you can save money in the form of bank deposits. But banks don't actually offer you very high interest rates. So if you want to save your money in an FD in a bank, well, let's suppose they will offer you 7% interest rate. But government has various schemes, okay, under which if you give money to the government in a fund, well, government will give you 9% interest rate, more than what banks are giving you. Okay. So therefore, many people decide to deposit their money in these funds given by government. The money collected in these funds is taken to a final major fund called National Small Savings Fund. Okay. Clear? Very simple. I'll explain it in detail. Now, the news was that during Delhi elections, Delhi government wanted or wrote to the central government that we need 10,000 crore loan from this fund. But the central government was not ready to give it to them. Okay, that was in the news. And that's all you need to know from this, because no question will be asked from the controversy between Delhi government and central government. That's political. What we need to extract out of this news item is that what is National Small Savings Fund. All right. So let's talk about National Small Savings Fund. Okay. So loan from National Small Savings Fund. Okay. So National Small Savings Fund. You see, people have many savings. Now they have various options. Okay. To basically park their savings. They can basically deposit their savings in a bank. And bank might offer them some interest rate, but usually that interest rate is low. Okay, they can also decide to invest their savings in stock market, share market, mutual fund, and whatnot. Okay, now government gives you another option. Government comes out with these schemes. Okay, and let's suppose the name of the scheme is National Savings Certificate. Government says that bank is offering you 7% interest rate. If you deposit money in this National Savings Certificate, we will give you 9% interest rate. But remember, it is a small saving scheme. You cannot invest all your wealth in that. Small savings are only allowed. Clear? Similarly, there is this scheme which much of you are familiar with. It's called Provident Fund. Okay, so you can park your savings in this Provident Fund, and Provident Fund would offer you higher interest rate. Okay, so apart from stock market, banks, people have the option of investing money in these small savings schemes. Okay, all the money invested in these small savings schemes go to National Small Savings Fund. Okay, so people's savings go to this National Small Savings Fund, and government offers you an interest rate. Let's suppose that interest rate is 9%, which is more than bank's interest rate. Clear? Now, after some time, government has to return this money back to you with 9% interest rate. That's the idea. That's why you have invested. Simple. Now, what does the government do with this NSSF? Okay, what does the government do with this money? Well, this National Small Savings Fund, whatever money is basically collected in this fund, is further invested in government securities. Okay, NSSF gives loans to central and state governments. Okay, government NSSF earns some interest on it. Let's suppose NSSF earns 11% interest rate on it, right? So NSSF takes money from people in the form of savings, invests it further at a higher interest rate, earns some money, and returns this money back to people after 9% interest rate. That's the thing. And the idea behind this was that, well, government wanted to give alternative saving mechanisms to people. Okay, make sense? Some of the examples of these schemes are National Savings Certificate, Public Provident Fund. All right. Now, NSSF collects this money and buys government securities, government bonds. And I have mentioned this to you that bonds are nothing but borrowing instruments. Okay, so these government bonds can be central, state government bonds. Okay, and center and states are borrowing from NSSF at a higher interest rate. And the reason why they are basically borrowing at a higher interest rate is because NSSF is already taking this money at 9%. NSSF cannot loan out this money at 8% because then NSSF will lose out people's money. How will it return back this money to people? So necessarily NSSF has to offer higher interest rates to these loans. Yes, makes sense. Now, what does this NSSF do? Okay, so it does that. It buys central government securities, state government securities. Now, the thing is, governments generally prefer borrowing money from the market, from the banks. Why? Because banks offer lower interest rate on these loans. NSSF offers higher interest rate. Like I said, banks, because they offer lower interest rate to people, they can offer lower interest rates to loans. But NSSF cannot do that. Any which way, this is the thing. Currently, there are only 4 states that borrow money from NSSF. Okay, central government borrows money from NSSF. Only 4 states borrow money from NSSF. Delhi, Arunachal Pradesh, not Andhra, remember, Madhya Pradesh and Kerala. The reason why only 4 states borrow money from NSSF is very simple. Because NSSF loans are expensive. That is why many other states do not borrow from NSSF, they borrow from the market, banks directly. Clear? Any which way. This is NSSF, and Delhi government recently requested central government to give it 10,000 crore worth of loans from NSSF. Any which way, this is NSSF. Some extra information about NSSF. So it was established in 1999 under Public Account of India. Now, Public Account of India is a constitutional thing. It is established as per Article 266 Clause 2. Public Account of India is basically that account of Government of India, money for the Government of India, which is a liability because government has to return this money back to the people. Okay. Another fund is there with government, Consolidated Fund of India, which is also established under Article 266 Clause 1. But this is a money that is not a government's liability because they don't have to return any money from this. All the money collected from taxes is deposited in Consolidated Fund of India. But all the money borrowed from people in the form of savings goes to Public Account of India. Remember this. Okay. So remember, NSSF was established in 1999 under Public Account of India. It is operated by Ministry of Finance as per NSSF Rules 2001. And the only purpose of this NSSF is provide savings alternative to people. Okay, so that people have different areas to save their money. Simple? All right. Okay. And now let's move on to last topic of the day, which is indexation of LTCG. Now, indexation of LTCG. First of all, you need to know the full form of LTCG. LTCG stands for long-term capital gain tax. Okay. Now, to understand long-term capital gain tax, you need to know what capital gain tax is. Because if there is a long-term capital gain tax, there must be short-term capital gain tax, right? So to understand long-term, short-term, you need to understand what capital gain tax is, right? Okay. Now hear me out carefully. What is capital gain tax? The thing is, we all invest our money in assets. That can be gold, land, shares of a company, or any other thing, right? We buy assets to save our money in, to invest our money in, right? The reason why we buy land, most of it is because we want to build a house over there, right? But some we buy land for investment purposes. We think that if we'll buy land worth rupees 1 crore today, tomorrow we will sell it for 2 crores and earn 1 crore rupees, right? Many people do that. So people in urban areas buy land for 1 crore, then sell it for 2 crore. This 1 crore profit that they earned is known as capital gain. Okay. So whenever you sell asset, capital asset at a higher price, the profit you earn is known as capital gain. And government decides to tax that. Okay, so government taxes that capital gain, and that is known as capital gain tax. Now, if you buy a property, okay, land, okay, and you sell it within 24 months, 2 years, then you have kept that property for short term. So, short term capital gain tax would apply. But if you buy a property and sell it after 10 years, after at least 24 months, 2 years, then you kept that property for long term, then long term capital gain tax would apply. Clear? Makes sense? Right? So this is what capital gain tax is. Now we'll try to understand what this word indexation means. Okay? So let's jump into this topic, indexation in LTCG. Okay, first let's talk about capital gain tax. So capital gain tax are profits earned from selling capital assets like land, buildings, jewelry, or even virtual digital assets like cryptocurrency and all. Okay? Any profit or gain that arises from the sale of a capital asset is known as income from capital gains, and that is taxed. Okay? Such capital gains are taxable in a year of transfer of capital asset, the year in which you sold that capital asset. Okay? Now, which assets are excluded from capital gain tax? Well, if you have a business and you have kept a stock of raw material and you decide to sell that raw material at a higher price, well, that won't be taxed. Okay, so raw material is not considered capital asset. Personal goods for your personal use, okay, furniture, paintings, cars, no. Agricultural land is, well, exempt from capital gain tax. So if you buy agricultural land and sell it at a higher price, exempt from capital gain tax. And then we have talked about it in the previous lecture. Sovereign gold bonds, they are also exempt from capital gain tax. Now there are two types of capital gain taxes. Okay, long term LTCG, long term capital gain tax, short term. Okay, now let's talk about long term and short term. Okay, now any asset, any capital asset that you have held for up to 24 months or less. So let's suppose you bought a piece of land and sold it within 24 months. Then that would be called a short capital asset. Okay, clear? And on short-term capital assets, short-term capital gain tax would apply. But let's suppose you bought that piece of land and sold it after more than 24 months. Okay, after 3 years, 4 years, then that is long-term capital asset. And then LTCG would apply. Okay, this is the case with normal assets, normal capital assets. But when it comes to shares of a company, share market, shares in a company, Bombay Stock Exchange, National Stock Exchange, any bonds, debentures listed on Stock Exchange, Bombay Stock Exchange, bonds, mutual funds, if you are talking about these things, then the time period is not 24 months, it's 12 months. So if you buy shares of a company, okay, and sell it after 1 year, then short-term capital gain tax would apply. But if you sell it after more than 1 year, let's suppose 15 months, then LTCG will apply. So when it comes to stock market, well, the time period threshold is 12 months. For all the other assets, it's 24 months. Okay, simple? Yes. Now, to understand this part about indexation, let me give you an example. Okay, hear me out carefully. All right. So let's suppose you bought a piece of land in 2010. Okay, and that piece of land costed you 1 crore rupees. In 2020, you found out that this piece of land now is worth rupees 4 crores. Okay, so you decide to sell this piece of land at 4 crores. Clear? Now what will be your capital gain? It will be 3 crore profit that you have earned. So government will decide to tax this. Clear? This is your capital gain, 3 crore. Now because you sold this land after 10 years, that is more than 24 months, then Which tax will apply? Well, good. LTCG will apply, long-term capital gain tax. Now the thing is, government gives you a benefit of sorts. Okay? Government says that we won't consider your capital gain to be 3 crore. Okay? Government says that we will actually take into account inflation. Okay? It is said that this land costed rupees 1 crore in 2010. Okay? And after 10 years, as per inflation numbers, as per counting inflation, this land should have been 2 crores. So if we take into account inflation in everything, then in 2020, this land should have been 2 crores in 2020. But you sold this land for 4 crore. So if we account for inflation, then this land was bought at 2 crores and sold at 4 crores, right? So in a sense, you only gained 2 crores. If we account for inflation, if we take into account inflation, you only gained 2 crores, and your capital gain tax will be applied on this 2 crores, not 3 crores. So your tax gets saved. This method is known as indexation. Simple. This is indexation. But in the previous year's budget, government decided to do away with this indexation. What did the government decide when it comes to LTCG? After budget 2024, long-term capital gain tax is taxed at 12.5%. Earlier it was 20%. Government in budget of 2024 decided that we will reduce long-term capital gain tax to 12.5%, but we will discontinue with the benefit of indexation. Now you won't get the benefit of indexation. Now inflation won't be taken into account. Okay, so your capital gain would be considered 3 crore only. Okay, but yes, earlier you would have been taxed 20%. Now you'll be taxed at 12.5%. When it comes to short-term capital gain tax, there are different slabs for it. You don't need to get into that. All right. And with that, we conclude today's session. Thank you so much for watching, everyone. And I'm sure it has added value to your preparation. Now, some of you who are asking for schedule and notes, it will be provided to you soon. Okay, notes for these lectures, MCQs for these lectures, which are mandatory for you. By the way, if you really want your preparation to be top notch, you need to revise from notes and practice MCQs. These notes and MCQs would be provided to you soon, don't worry. And the detailed schedule of this entire Prelims Powerplay lecture series would be provided to you very soon. So don't worry about that. My request to you guys would be just stay consistent with this lecture series. Just stay consistent till your prelims examination. Okay? And on that note, I'll be signing off. Thank you so much, everyone.